And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday as we get through, Monday, right? So Monday, not a good day on the markets yesterday. Fairly decent sell-off that we've had. Again, kind of not really surprising. We've been talking about this for a while now. Markets have gotten very overbought, needed a correction. Yesterday was a decent one. And in fact, kind of the last 2 days, on Friday and then yesterday, had a gap down open yesterday morning, finished the day at the lows. We actually gapped down at the open and then we'll lower all day, finishing at the close, finishing lower yesterday. Now, as we've been talking about here recently, there's quite a few levels of technical resistance in here, right? So, the 20-day moving average, then the 100-day below that. Well, we sliced right through that 20-day moving average yesterday. So that puts the 100-day moving average right now in focus, and that's around about 4,080 on the S&P. So just below where we are now, not a big deal. Markets look to open up a little bit this morning. Not surprising after a big sell-off day yesterday. Not surprising to see a little bit of oomph, kind of back in the markets. It's too soon now. For the bulls to just completely abandon the rally, right? So we've had this very nice rally, got the bulls all excited. It's something that we talked about, back in late July, saying, what we needed was a rally that got Jim Cramer on CNBC to start pounding the table. It's time to buy stocks. And, well, markets rallied, and that's exactly what he did. Of course, after the CPI report had come out just a week or so ago, we saw the odds of a Fed rate hike drop from 75 basis points to 50 basis points. And the market got very assured here with this rally that the Fed was about to pivot, right? They're going to start to slow their rate hikes, etc. Well, the problem is that since then, those odds of a 75 basis point rate hike in September have been creeping higher, and they've been coming back up. So now there's about a 70% probability that the Fed's going to hike 75 basis points in September. Now that's a lot more than what this market rally was expecting, and not surprising. That's starting to kind of worry the bulls here a little bit. So the point here is this: we've got a lot of things coming up here very soon. The first thing is, of course, we've got the Jackson Hole, Wyoming Economic Symposium Summit Fed Chairman Gala extravaganza, right? So this is where all the central bankers all over the world, they all fly in, increase their carbon footprint, and are going to confab about, ruling the world and what we need to do monetary policy-wise globally, to fix the problem. And look, inflation's a problem everywhere. And what's interesting is that we did all this money into the economy back in 2020, 2021, and we created all this inflation because when we shut down the economy, we had no production. So now people had money to spend, so they went out and spent it. That drove up. So you had a lot of demand, no supply. Basic economics says prices go up, and so you have inflation. And of course, everybody's saying, well, that wasn't the government's money that did that. No, it wasn't that, because there's inflation everywhere. Well, that's true, because we export inflation. And of course, what we did here was also being done in other countries as well. Other countries were doing the same type of thing to help support their economy. But we export our inflation through offshoring and production, and we import cheap stuff. So when we create this booming demand for products, goods, and services that we don't manufacture here, guess what we do to the inflation of other countries? That's right. We drive that up. So, we're kind of like the virus, and the whole world is now impacted by that. Now these global central bankers are all trying to figure out, well, after doing a decade of monetary liquidity, we need to reverse this course. In fact, we have a record number of banks now starting to talk about tighter monetary policy, not looser monetary policy. So again, this is going to start to weigh on economic growth worldwide. Central bankers are in a really kind of a tough spot here in terms of how to navigate this, right? They've got this inflation challenge on one hand, but yet they have very weak economic growth on the other hand. And this is going to be a very tough environment. We talk about stagflation all the time, and that's an environment where you have high inflation and low economic growth. Well, that's what we got. So again, it's going to be interesting to watch here. Now, technically speaking, what we're looking for here is the markets to try to hold support somewhere in here between the 100-day and the 50-day moving average. We'll see what the markets do today. Wouldn't be surprising to see a little bit of a bounce. Might want to use that bounce temporarily just to kind of, if you've had a nice run up in your stocks here, have some positions you need to kind of rebalance and stuff, be a good time to do that. The reason is that the MACD signal, again, this is kind of the primary technical indicator that we watch here for kind of buy and sell signals for the markets. It flipped to a sell yesterday. So unless we have a very, very strong rally today or tomorrow, that MACD sell signal is going to stick and potentially start to work its way lower, and that's going to apply downward pressure to markets. And so again, kind of just pay attention to this. We have an important sell signal in place. Suggests that markets could be sloppy here. Now, doesn't mean that we're about to go back and test lows. I was on Charles Payne yesterday on Fox Business News talking with him about this. Like, are we going to retest lows? It's like, it's hard to say we're going to retest lows. Is it possible? Absolutely. But it's hard to say that, yeah, definitely we're going to retest lows here. There's a lot of support here, as we've been talking about over the last few days. We did break through the 20-day moving average, but we do have the 100-day right below it, then the 50. So again, lots of technical support here very shortly that could allow markets to kind of bounce down to lower levels, work off this overbought condition that we have. And again, then set the market up for the next rally. So as long as the markets can hold the 50-day moving average, form a higher bottom than what we had back in July, well, that is bullish. And going into the end of the year, that would set up for a stronger market environment in the stronger, in the seasonally stronger period of the year, October, November, December. So, over the next month or so, if markets can kind of work off some of this overbought condition, not completely fall apart, then there is a potential here to add exposure to portfolios. But again, just be wary here that we are still moving into tighter monetary policy. The Fed is tightening their balance sheet. That's ramped up to $95 billion this month. Pay attention to what they're going to say at Jackson Hole this weekend. They've got the September meeting. So there's a lot of things here over the course of the next, really 3, 4, 5 weeks that could roil the markets. We're out of earnings season. That's behind us. Estimates are now starting to come down fairly rapidly. I was updating our earnings analysis yesterday, seeing a fairly sharp decline in earnings estimates now. We were running about 240 back in July. We're down to 213 now. So already about a 12% clip off of earnings. And if we do go into a recession later this year or early in 2023, the normal earnings decline for the S&P is about 25 to 30% at least. In a light recession, if you get into a real recession, could be as much as a 50% decline. So, you're looking at a target of about 180 potentially on the S&P in terms of earnings. Now, if earnings drop to 180 and prices are still where they are right now, valuations are kind of soaring back up. So, again, these are a lot of things to kind of just take in. I know it's a lot of this, kind of disparate information. But there's a lot of bullish bias right now where people are just like, oh, the bull market's back. I'm seeing a lot of headlines, throwing out technical, measures. When the market did this or that, bull markets are always back. Look, we do have issues that we don't normally have. We have high inflation. We've got slow economic growth. We've got declining earnings. And we've got a Fed that is aggressively moving to tighten monetary policy. That's not friendly to stocks. It's something that we at least need to be aware of. Doesn't mean that we need to be really bearish, but just be aware of it. We'll be right back. We'll talk more about it, you and your money, right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions, to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. All right, now this is funny. Brent always puts a little something on my my show notes in the morning. Says, I was thrown out of the break room at Walmart. They asked me what I was doing there, and I told them I was on break, and they said, "You don't even work here." He said, "Sure I do. I just finished using the self-checkout, so clearly I work here."
Exactly.
It's true, though.
Yeah.
That is true. We went to, I told you we recently moved my son up to A&M, and my daughter up to Target. We moved her to Target. We moved her to Texas Tech. And of course, the traditional thing with it is to go to Target, shop for all the crap they need, right? Mm-hmm. All the stuff they think they need.
Right.
And so we were in Target at A&M and going through the store, and there was like It wasn't really busy because we were there like a few days early before the actual move. I'm sure like move-in date, it was.
Oh, last weekend was awful.
I am absolutely sure in College Station it was crazy.
Yeah.
So we were there about a week or so early, so it wasn't bad. So we went to Target, and there was basically about maybe 20 people in the whole store, right? And then they had one checker, right?
Yeah.
And then there was a self-checkout line.
Right.
Yeah.
And was it backed up?
No, it wasn't. But the whole point is like you have one checker in the whole store.
Yeah.
Right.
Yeah.
So if you have a rush, you're screwed. So yeah,
It's that
So
way
much
all
of-
over.
I know. Do you remember back in the day when you went to the gas station to get gas,
Oh, yeah.
and the guy came out and like filled your gas tank for you and cleaned your windshield, checked your oil,
Pop the hood.
popped the hood,
Yep.
all that, and then.
Never again. That's a thing of the past.
I've been thinking about restarting one of those. I think it would be a hit.
Oh,
I think,
no doubt.
I think that people would like that kind of service.
I would gladly pay a premium on gasoline prices for that service. I would.
I know.
There's a way we could jazz that up, but I'm not going to talk about it here. I saw the look on your face.
Yeah, you knew where I was heading. Of course, the women may not like it, but well, you have to maybe maybe
equal opportunity.
exactly.
Go both ways.
Anyway, back to the show.
Second gig for firefighters. Just saying.
Could be the case. Just have to figure out how to make it profitable.
I'm sure there's a government grant for that somewhere.
Well, I guess, you really won't need it eventually. Well, I guess you will, honestly, when everything becomes superchargers, right?
Yeah.
You'll still need somebody to come out and plug the supercharger in for you.
Got to have someone to clean the contacts.
Exactly. And then, while you sit there for 45 minutes, they dance and sing songs for you while you charge your car.
There you go. Serving adult beverages.
There we go. Mm-hmm. Supercharger station with a bar and
servers.
No, like Broadway theatrics, right?
Yeah, live show entertainment.
Have live show entertainment while you're there for your 45 minutes or an hour and a half, whatever it takes to recharge your car.
Think of the possibilities.
Somebody's at home going, that's $1 billion idea.
Copyright Lance Roberts 2022.
Yeah, exactly. Yeah, that ain't going to happen. Okay, couple of things to get into. AMC. We talked yesterday, our daily market commentary yesterday on the website, if you go to realinvestmentadvice.com, was Bloodbath and Beyond. And of course, we were talking about the decimation of shareholders in Bed Bath & Beyond after the very sharp 3-week run-up in the stock price that came to a very sudden and ugly conclusion as everybody that was pumping the stock up bailed out of the stock. Ryan Cohen and others. So, there was a few people that made money on that deal. There was a whole lot of people lost money. I'm just waiting for the lawsuits to show up for that one. AMC yesterday, another one of those stories in the meme stock space, was down about 44% yesterday as Cineworld, we talked about this on the show yesterday morning, is filing for bankruptcy. Look, the reality is people aren't going back to movie theaters, at least not right now, and faces a couple of problems. The whole theater chain faces problems, not just Cineworld, but also AMC, everybody else, is that there's too much competition now between online streaming, which is cheaper than going to a movie. So, it's one of those things that, it's just a changing economic environment, and that Cineworld bankruptcy, I keep wanting to say Cinnabon, Cineworld bankruptcy rolled over, and that's also Regal Cinemas. Cineworld is Regal Cinemas here in the U.S., rolled over into the AMC shares yesterday. This morning, as we talked about yesterday, the APE shares, which are the AMC preferred equity shares, will be trading this morning as well. So just the saga of the meme stocks continue. But again, as I said yesterday, that whole kind of meme stock space has really just kind of come apart over the last few days. But again, that was that coincident rally that we saw in the markets over the last several weeks. Really since July, money was pouring back in the market. So a lot of short covering. A lot of that short covering was in some of these, kind of more speculative names. So we saw those stocks run up. And then, of course, now that a lot of that short covering's been done, the selling came back and started to hit those stocks in particular yesterday. And we kind of saw, pretty much a broad-based sell-off yesterday. The positive news was that, it wasn't, just one of those disaster days in the markets. The market did gap down open yesterday. We talked about that just a few minutes ago, and spent the rest of the day kind of just grinding its way lower. It just never really kind of got off the mat, and just that was just a fairly consistent level of selling all day long yesterday, and it was really pretty much broad-based across the board. Energy did a little bit better than other sectors. Of course, it was already kind of beaten up, so money kind of rotating towards those energy stocks. Energy stocks were still down a little bit yesterday, but not nearly as much as kind of the tech space. Amazon, Google, Microsoft, Apple, those were kind of leading the charge lower yesterday. So we'll see what there is kind of follow through wise today. Futures are like I said, are about flat this morning, and not surprising, but I wouldn't expect it to hold. If we do have a little bounce this morning, I think people are going to sell into it. So if you need to rebalance your portfolio, this morning might be a really good opportunity to do it. If the market does kind of bounce up a little bit, I do think it kind of sells off potentially later today as investors are starting to get a little bit worried here. As we talked about, the odds of Fed rate hikes are going up, more aggressive ones. And, the economic data is okay, but it's not great. And we still have a lot to do in terms of, dropping earnings estimates and getting them more in line with, economic realities. And that means that prices are going to have to reprice lower at some point to kind of line themselves with lower earnings. And, as much as that we kind of want, markets to stay elevated, regardless of what what else happens in the economy. Unfortunately, markets are ultimately tied to economic growth, which is what feeds into and provides revenues and earnings for companies. So again, it's really just kind of hard to fathom how, this market rallies to all-time highs here with what's going on economically in terms of just inflation and economic growth, but then layer on top of that, as I said a minute ago, with the Fed aggressively tightening monetary policy, and not just domestically, right? This is globally, and as I said, we're going to have the global confab of central bankers converge on Jackson Hole, Wyoming, at the end of the month, to talk about what their next moves are, and I doubt very seriously they come out of that meeting saying, well, we're done, time to start lowering rates again and getting back to zero. Just don't really see that, happening. And so that suggests that this market could remain under pressure for a little while longer. So we certainly want to kind of just pay it, just kind of paying attention to, those risks that are out there. And this is kind of, as I said, I was talking with Charles Payne yesterday and discussing, this very fact, which is that, it's easy to be bullish when markets are going up. It's more difficult to separate out, though, in an environment between technically bullish indicators, which we do have, and as we've talked about this on the show several times, that the number of stocks above their 50-day moving average has reached 90% historically. That's pretty bullish and tends to lead to higher prices over the next 6, 8, 12 months. A 50% retracement of the decline normally says a market bottom is in, but this time is different. This time is different. If you go back to the 60s and 70s, it was interesting because you had several points in that period that 50% retracements of the decline did lead to new highs. And you're like, see, it's true. And it was true. And unfortunately, each one of those new highs led to a bear market that went right to a lower low. And it was this repetitive grind of rally, decline, bear market, rally to a new high, decline to a new low, rally to a new high, and in 1974, he got wiped out. And it was this kind of broadening base of these bear markets over about a 15-year period, which left investors with negative real rates of return over that entire period. And it was tough. And that's the only comparable period that we have to look at compared to now, considering where inflation is and what the Fed's doing to combat it. Am I saying that we're about to have that same type of environment now? No, every time is different. But from a variable standpoint, it's the only thing we have to look to for some type of precedent to suggest what could be the outcome for stocks. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I priced out putting solar panels on my roof. I was curious to see if I could really save some money. It was going to be like 60 grand, including the tax credit, to put panels on my roof. And so I calculated it out. It would take me like 32 years to get my money back.
The Real Investment Show podcast.
That's great, but the things we're providing tax credits to are super expensive things that only rich people can buy.
At realinvestmentadvice.com.
You know, somebody making 30 grand isn't driving a Tesla.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
And And good morning. Welcome back to the show. It's 6:30 as we kind of get this Monday going. A little bit of economic data out this morning. S&P has their global U.S. manufacturing PMIs out this morning for both manufacturing and services. Also, the Richmond Manufacturing Index is out as well, expecting a negative 0.5 read on that, or negative 5 reading on that versus 0 previously. Those reports have been coming in a little bit better than expected. Expectations have gotten really kind of ratcheted down, so we've seen quite a few of the manufacturing indexes kind of beat estimates here lately. And again, not surprising. This is why we're seeing economic surprise indexes go up. The Atlanta Fed is still ratcheting a little, some growth for the third quarter. And again, that's not really surprising at all. Quarter one, quarter two of this year was a big inventory reduction process for companies. They had ramped up on a bunch of inventory. We talked about the bullwhip effect, wrote an article about that at realinvestmentadvice.com. And so really a lot of that negative GDP we saw in the first quarter was a contraction of consumption, but also this liquidation of inventories. We just saw in Target's recent report that they had been slashing prices dramatically to get rid of stuff. Amazon Prime Day had a bunch of sales, but they were selling stuff for like 89% off, just trying to get that inventory out the door. So that certainly drags on economic growth. So, very well could see a bit of a positive revision to quarter two economic growth, gets that back into positive territory. So then we'll see, basically, just 1 quarter of negative growth in the first quarter, a little bit of positive growth second quarter, and then kind of flattish growth in third and fourth quarter. Wouldn't be surprising as we head into the end of the year. You've got Christmas, Thanksgiving, all that. We talked about that yesterday. So again, as we, kind of look at this, we have to juxtapose that to what the Federal Reserve is doing, as we're talking about, and what's coming down the road. And again, that's going to be slower economic growth. So, you have to remember that coming into this year, economists were expecting 6% annual growth in the economy this year, and we're not going to get anywhere near that. So all that's getting revised backwards now. And of course, that slower economic growth was also what propelled earnings estimates to be as high as they were. So all that's got to work backwards. So again, this is why, as we're talking about, just it makes it a little tough here to navigate the markets. I know we've been talking about this a lot lately, and I wish there was just a really clear answer for you. Just says, hey, go buy this and go buy that, and you'll be fine, right? But, that's just not the way it works. And what's interesting is that, we still have a lot of individuals that kind of expect markets to be making a positive return. I got a very interesting email just the other day from a guy saying, I don't understand why my portfolio is down this year. And, it's like, I have an advisor and I don't understand why my portfolio is down. Why aren't we making money this year? And, it's like, because the markets are down. If you're investing in the markets and markets are down, you're going to be down. And it's interesting. It's like, well, you can short the market and you can do those things. And yes, you can. The problem with that, ultimately, and trying to make these kind of major moves, and wonder, I'm going to be long the market when the market's going up. I'm going to be short the market when the market's going down. I'm always going to make money. Sounds great in theory. Doesn't work out that way, because by the time you realize you need to be short, it's too late. By the time you realize you need to be long, it's too late. And, people that invest in, very negatively biased funds tend to miss out on kind of the majority of the gains in the market. So those that are, invested in very aggressive growth funds tend to take the big brunt of the hit during down markets. And so this is why it's always important to try to find a balance where you're happy with returns when markets are going up, and you're okay with whatever losses you take when the markets are going down. So if the markets are down 10 and you're down 3 or 4, okay, right? No big deal. But that's investing in how you have to approach it. And trying to always make money in the markets is where people get in very difficult positions, because they wind up getting on the wrong side of the trade eventually. And that's just a function of time. You may time it a few times and get it just nail it just right. But eventually you're going to miss it. And then that's going to be the problem. And this is why it's important that, as I said, is to find a balance to your portfolio that says, okay, if markets are up, I can generate, if markets are up 10, I can generate 6, 7, 8%. If markets are down 10, I'm going to lose 3 or 4. Now, if you can find that balance and be happy with it, then you're going to be great long term. Because again, when you're not, even though you underperform in years that markets are higher, if you can outperform in negative years, you're going to wind up beating your benchmark index over time. Now, you're not going to beat it every year. And this is some of the big fallacies that I see from people that they report every year is like, last year, 87% of large cap funds underperformed their index. Okay, so what? Trying to pick the one fund that is going to outperform in a given year is just as hard as picking the one stock that's going to outperform in a given year. And most likely, if you pick the one fund that outperforms the index in a given year, they're going to underperform the next year, right? Hot funds never tend, and this is the big problem with investors, they tend to chase the hot fund, right? They get the reports and, Money Magazine that says the top 10 best performing mutual funds last year were, and everybody goes and buys those funds. And whatever the catalyst was driving that fund generally doesn't last much longer. Generally funds outperform 1 or 2 years and then they underperform. And it's just because of the market dynamics change. The market changes. And so whatever strategy was working for that little brief period is going to change. If you look at a periodic table of returns as a good example, it'll tell you that, this year commodities are outperforming. And about midway down the list is the S&P, and at the bottom is emerging markets. So if you looked at that periodic table of returns, you go, okay, well, if commodities are outperforming, I need to buy commodities. So you buy commodities. Well, if you look at a periodic table of returns over time, what you'll see is that commodities never are the top performer more than for just about 1 year. And then they drop to the bottom performing list. And generally what's ever at the bottom of the list goes to the top of the list in the next year. So if you really want to try to outperform the market, buy what didn't work last year, and you'll wind up doing better over time, right? Somewhere in the middle, most of the time, is the S&P because of the way it's structured. Kind of floats around the middle most of the time. Sometimes it's at the very top of the list, but not very often. And so, and this is why, trying to chase what was working doesn't really work out well. But having a balance and some diversification and some risk management does work over time. And again, you're not ever going to be at the top of the list, but you're not going to be at the bottom of the list either in terms of performance. You'll be somewhere in the middle most of the time. But that'll help you win over the long term. And I know that's hard because we get so wrapped up in the competition of having to beat the index this year. I got to beat it now. I got to be making more money than everybody else now. And what we wind up doing is taking on a lot of one-sided bet risk that tend to go in the other direction. As we were talking about back in late May, early June, oil prices were so overbought that they were going to have a correction. And at that time, everybody was just piling into energy stocks. Well, here it is 2 months later, nobody wants to buy energy stocks anymore. Now's a good time to buy them. Well, a better time to buy them, I should say. Not necessarily a good time, but a better time to buy them because they've had a big correction. And so your opportunity there for a rotation from growth back into materials, commodities, et cetera, is opportunistic. Dollar's getting stronger. So we'll see. But these are the things we have to think about. And there was a very interesting article on CNBC this morning talking about the growing risk of a major financial accident that causes a market capitulation later in the year could open up opportunities for investors to pile up on quality risk assets. This is according to Beat Whitman, chairman and partner at Zurich-based Porta Advisors. With risk from inflation, economic slowdown mounting, and central banks treading on increasingly narrow monetary policy paths, Whitman characterized the global economy as stuck in a perfect storm environment of supply chain frictions, contracting final demand, high inflation, rising interest rates, falling corporate earnings, and a potential for a financial accident. And that's the battle, right? That's one camp here. The other camp is that the bottom of the market's in and we're all going higher, so you've got to make your bet, right? You've got to pick your place. Or you pick a little both. You build your portfolio to capitalize if markets rise and to hedge some risk in case markets do go down. But that's ultimately is the challenge that investors face. And the mistake we always make as investors is we tend to do a lot of hindsight bias in terms of making our asset selection instead of looking at where the markets are heading to instead. Be right back after the break.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
This morning, get ready to wrap it up. Few earnings out this morning. Zoom Video Communications, they rose to prominence during the economic lockdown. Zoom was this little online video company, kind of out of nowhere. It's like online meetings. Everybody was like, prior to the pandemic, it's like, who wants to do that, right? Nobody wants to sit there online on a computer and visit with other people. That's stupid. FaceTime for computers. And then, of course, once the lockdown came, that's where everybody went. And Zoom did two things that was, amazing, which is, one, they were in the forefront of it, right? So they were one of the early early adopted software programs. I mean, Teams was out there, Skype was out there, but they had made a lot of inroads to a great degree. Teams has become more popular now as people were looking for alternatives to Zoom. And then since Zoom and since the lockdown, obviously there's lots of platforms now. There's a bunch of streaming platforms that are out there, so people have options, which is problematic. But what is important about Zoom is they became the acronym for online meetings. It's kind of like when you go into a restaurant and you go, I'll have a Coke. Well, do you actually want a Coke or do you want Dr. Pepper, Sprite, whatever? But Coke kind of became ubiquitous for carbonated drinks, sodas. Zoom became the ubiquitous term for any online meeting. The people even got nicknamed Zoomies and Zoomers, right? So it's they achieved that status, right? Kind of like Starbucks. They became the ubiquitous term for a coffee shop. Well, they reported earnings yesterday, and I thought it was interesting because, again, the two problems that Zoom has, and this is the problem with all these technology companies in general. It's the problem with Facebook. It's the problem with all these others. And again, judging by the amount of crap that I have on our Facebook page, I can assure you that out of, Facebook claims they have like 1 billion users. I'll bet 900 million of them are bots and fake accounts. I don't think there's really that many people using Facebook anymore. That's just my opinion, but everybody's pretty much tuned out of that nonsense. And we'll see what happens to it. But the point is there's no barrier for entry. It's not difficult to hire a couple of programmers and create another Zoom, right? And call it something else. And take what people are missing in Zoom and add it to another platform, so you have, a competitive platform. And then, of course, now as people kind of getting back out to the world and realizing that you don't have to be locked up in your house anymore, you can actually go out into the world. This is an awesome thing. The need for Zoom is declining a bit. And that kind of showed up in their earnings. Zoom was down 11.5% pre-market. Or is down 11.5% pre-market, after the video conferencing company cut its full-year forecast. Zoom reported better than expected earnings for the last quarter, but revenue fell short of forecast. Zoom CFO said the company is having some difficulty attracting new paying subscribers. And see, that's the problem. There's too much competition. Same for streaming services, right? Netflix is having problems. Disney's going to have problems. Too much competition in the streaming services. They're trying to raise prices, and consumers are going, I got better alternatives, or I've got other alternatives. As one of the, if you remember a while back, we were talking about cable, and everybody was like, well, everybody's going to cut the cord. We're all going to go, just go internet streaming. We're all just going to stream just our services, right? We're just going to have Netflix and then Hulu and Amazon Prime, whatever. So everybody launched these streaming services because we're supposed to cut the cord. Well, what everybody's figuring out now is that by the time you have all your services, it's cheaper to have cable. And you still got to pay the cable company for the internet because without the internet and the Wi-Fi, you don't stream anything. So, there's your problem. Unless you have unlimited wireless data and you're just going to stream it over your phone bill. So, these are the challenges with these areas. And look, there's going to be a winner in all of this eventually. There's going to be the winner. And the question is going to be which one it is. The problem for Zoom is that revenue growth is slowing down to single digits, which is kind of what you would expect to happen. I mean, this is a company that matured very quickly in a space that's becoming very crowded very quickly. And, this is a company, now this Zoom is down, from its peak, which was around, just shy of 600. Stock's down to 97.44. So you've clipped a lot off the value of this company over the course of last year. And basically, Zoom is basically returning back to where it kind of originally IPO'd, more or less. And still, even after that decline, right, from 600 to 97, it's still trading at a price to sales of 7 times, which is very high. Now, it was trading nearly 20 times price to sales, so you've cut a lot of that nonsense out. But still, a 7 times price to sales, that's very pricey. And you've got to have revenue growth, at 300 or 400% a year to maintain that price to sales level. And this is a company that has sales of $4.2 billion, but income of about $1.2 billion on it. So it does make money, which is good, but still valuation is very expensive. And even on a forward PE basis, they're still trading at 24 times earnings. So again, it's a pricey company, even at these levels. And now you're talking about single-digit revenue growth going forward, which is going to make this even more complicated to try to maintain that. So, and again, and as I was saying, the more, there's other choices out there as well. Palo Alto Networks, they're up a bit this morning. Earnings were better. Cybersecurity company. Now, cybersecurity is a space that, is interesting. Everybody's getting hacked all the time, so cybersecurity makes a lot of sense. Company reported better than expected quarterly results, issued an upbeat forecast. Palo Alto is also announcing its board of directors have approved a 3-for-1 stock split. So that's helping lift that stock this morning about 10%. But here's another company too. I mean, when we come back and kind of look at Palo Alto, this is a company that, again, traded at very high multiples, still trades at a 9, almost 10 times price to sales. It's still very expensive. And even though they've got, strong sales, their sales are about $5 billion right now. They have a negative $389 million in income. So this is still a very expensive company. The company's come down from about $650 to $500 this year. So, and it's going to rally again. It'll rally a little bit this morning, but again, this is a very, it's a stock in a very good space. But the problem with a lot of these tech companies is that they're still very expensive. They all had huge runs during the kind of the speculative mania in 2020, 2021. And Palo Alto Networks is a good example, hasn't really given up a lot of that game. So it's still trading at very expensive multiples. And as we've talked about here on the show before, when you buy something at 10 times price to sales, in order to justify that, the company literally has to pay every single dollar of revenue out to its customers. It can't pay for employees. It can't pay taxes. It can't pay dividends. It can't pay anything, which is a little bit illegal in a lot of cases. So, when you think about 10 times price to sales, it's very important long term. And fundamental valuations do eventually matter. And it's just a function of when that they matter. I mean, but again, cybersecurity is one of those areas that there's a big need for it. So it's a justification. You have to just realize that you're really overpaying for asset prices in some of these areas. Dick's Sporting Goods, a retailer, beat top and bottom line for the second quarter, raises full year forecast. Comparable store sales sank by 5.1% for the quarter. Medtronic gained 1% in pre-market after reporting a quarterly profit and revenue. JD.com, they saw a 9.2% increase in active customer use. This is the kind of the Chinese-based e-commerce company. Warner Brothers Discovery, nearly 10 million viewers watched Game of Thrones, HBO Max last night. It was the biggest premiere of a series in HBO history. 10 million people watched the Game of Thrones prequel called House of the Dragon. Now, actually Sunday night at 9 p.m. I didn't stay up that late to watch it, but I will get around to watching it. This is a record for the HBO series debut. Warner Brothers Discovery gained about 1.4% pre-market. Again, one of the big challenges for Warner Brothers, HBO, Showtime, any of these is going, and there's so many of them, right? You got Paramount Plus, Disney Plus, Netflix. You have all these streaming services. The big problem is coming up with content and good content. So when you get something like a House of the Dragon that is following on a great series, Game of Thrones, that's a franchise. And there's lots of prequels and sequels and stuff lined up for Game of Thrones. HBO has like a decade's worth of material in the process coming off of Game of Thrones, kind of like Disney's doing with Marvel's. But, the problem is going to keep the quality up. And that's going to be the issue. To continue to attract new subscribers and new users, quality of content, frequency of content becomes a big challenge for online streaming services. All right. Wrap it up for this morning. Still didn't get to my story about more kids are fat and unhealthy because of global warming.
We'll just put that on tomorrow's page.
Yeah, I'll get there eventually.
Yeah.
All right, wrap it up for the day. Get by the website, realinvestmentadvice.com. When it comes time to buy stocks you won't want to, that's today's blog post on the website, realinvestmentadvice.com. Also, check out our Simple Advisor platform. All of our research, we just added some new tools there for you on relative rotation analysis and more to help you kind of sort through the markets. And also the Digital Advisor platform. The platform can actually manage your money for you. So it's all there, simpleadvisor.com. Have a great day. Be back here tomorrow.
All the things I could do if I had a little money. It's a rich man's world. It's a rich man's world.